All right, all right, all right. Happy Thursday, people. Thursday, 25th of June, and here we are, another beautiful workshop. How is it going, guys? Type a yes or no in the questions box. Let me know we have sound and image. Let me know how you're doing. Interact with me. Haji, nice to see you, man. Alvaro, nice to see you. A lot of people again joining us today. A lot of registrations. How is the sound? How is the image, guys? Let me know we have sound and image so we can get started. Yeah, type something in the questions box. Yes, no, we have sound, we have image. Let me know how you're doing. Meanwhile, let's get compliance out of the way. All information presented during this webinar is from public sources and should be treated accordingly. Our content is intended to be used and must be used for informational purposes only. It is very important to do your own analysis before making any investment based on your own personal circumstances. You should take your own financial decision or independently research and verify any information that you see and wish to rely upon, whether for the purpose of making an investment decision or otherwise. We would like to draw your attention to the following important investment warnings. The value of shares and investments and the income derived from them can go up as well as down. Investors may not get back the amount they invested, and past performance is not a guide to future performance. Hi, Alvaro. How are you, my man? How you doing? Type a yes or no in the questions box. Let me know how the sound is. Let me know how you're doing, how your day went so far. Okay, get your notebook and get ready for an amazing webinar. We will learn about minimizing the cost and maximizing the profit in trading. And I'm also going to show you a few trading strategies, the most common and simple trading strategies that professional traders use. And usually they get very good results. All right, let's continue. Let's continue. So for the ones of you that don't know me, my name is Andrew. I'm the founder and CEO of InstructFX and FX Battle Podcast. I go by the nickname of the Chart Whisperer. Used to work in the London financial sector, used to work in the industry for the last 10 years. In many international brokerages, institutional and retail. And today I will teach you what I know. So this is the webinar schedule we had this month. Yeah, today is the 25th of June. We're talking about how to minimize the cost and maximize the profit. And Tuesday, guys, 5 days from now, we have the special with the founder and CEO at Forex Cube, Joao Monteiro, a talk show moderated by yours truly, and it will be amazing. There is the cover. This is a sneak peek if you want. So Tuesday, 30th of June, same time, same place. Join me for an amazing webinar with Joao Monteiro, the founder and CEO at Forex Cube. Don't miss this one, guys. So let's get started. Let's get started. How to minimize the cost and maximize the profit in online trading. First of all, we need to understand what is the actual cost of trading. So we have, first of all, the spread, which is the difference between buy and sell. Yeah, which is, let's say, a commission that the brokerage takes every time you open a trade. Luckily, Forex Cube, an STP brokerage, gives you the raw spread that comes from the market and charges you the smallest commission in the industry, only $3 per lot traded. Okay, the average commission is anywhere between $7 and $12 per lot. Forex Cube only charges $3 per lot and gives you the crude spread from the market. So you have very, very good trading conditions. The second one is the swap or the rollover, which is a fee everyone pays for keeping trades open overnight. Okay, another one is the clearance fee. Some brokerages might charge a clearance fee, which is a small fee that applies when you close a trade in profit. On top of the in and out per lot, you also have a clearance fee. This does not apply with Forex Cube, but some brokerages out there do prefer this tactic, let's say. Another fee is the maintenance fee, again, which you might find in some brokerages. Hey, the maintenance fee is a small fee that applies for using the trading platform on a monthly basis. Losses, losses. Some brokerages capitalize on traders' losses. That is a big cost of trading, which you don't want to pay. No one should pay that cost, but unfortunately, sometimes we will have losing positions. What's very important is to dust yourself off and learn from your mistakes and try to recover, try to do better. Okay, another cost of trading, if you're a heavy trader, yeah, now I'm referring at the very big trading accounts that have big profits, big losses, yeah, but mostly big profits. In some jurisdictions, the government will tax profits from online trading. For example, in UK, this goes as spread betting, and as far as I'm aware, is tax-free. Yeah, obviously up to a certain amount. I'm sure even the UK government will look towards taxing big profits coming from spread betting or online trading. So this is the cost of trading. Okay, this is how this feels like you're running your own business. You have a gross profit and a net profit. Hey, it doesn't mean that if you see $100 profit on a position or $1,000 profit on a position, that is the clear profit. No, you're gonna have a tiny cost. Yeah, like the spread, the rollover, yeah, and so on. In terms of cost, when it comes to Forex Cube, be rest assured they have the smallest commission per lot in the industry, and they only have the spread and the swap that comes from exchanges. Yeah, so the fee that you pay for keeping trades open overnight comes straight from either liquidity provider or the exchange. Okay, they don't have any clearance fee, any maintenance fee. They do not capitalize on traders' losses because Forex Cube is a straight-through processing brokerage. What is the difference? I will tell you in another webinar where we will break down. So join me on Tuesday if you want to find out what the difference is between an STP brokerage and a market maker from the founder and CEO of Forex Cube, João Monteiro. Let's move on. Let's move on. Again, guys, interact with me. Type your questions if you have questions. What is the swap? What is the rollover fee? In foreign exchange trading, a rollover is the action taking place at the end of the day where all open positions with value date will be rolled over to the next business day. Trading platforms offer rollovers, but the process involves a rollover interest fee, which is calculated according to the difference between the interest rates of the traded currencies. If the interest rate on a trader's long position, yeah, on a buy position, is higher than the rate on a short position, the trader receives the interest. If the interest rate on the trader's short position is higher than the rate on the long position, then the trader pays the interest. Yeah, you have two types of swaps, guys. You have positive swaps and negative swaps. Most of the times, most of the swaps are negative, but you do have the occasional one that actually pays you for keeping the position open overnight. In the right-hand side of the screen, you can see a sell position on Euro US dollar. The volume was 0.5 lots, yeah, or 50,000. I kept this position open for a couple of days, and I managed to make a profit of $133. Out of that $133, I have to deduct the $2.15, which is the rollover fee, yeah, because I kept the trade open for 2 days. You see, it's not that bad at the end of the day. You won't see the rollover fee exceeding your profit. Okay, the rollover fee is a very small percentage. Again, that has to do with the interest rate between countries and also with your position sizing, yeah, which in this case is only 0.5 lots or 50,000. This is what the rollover is, or the swap. This is what you need to take into consideration when you're trading, especially if you're planning to trade long term. Let's move on to the next slide and see how can you minimize the cost of trading. You have a few strategies. The most common strategies are day trading and scalping. In the next couple of slides, I will break it down for you. I will explain to you what they mean. Another way of minimizing the cost is knowing your asset. Yeah, make sure you know what you're trading on, because you have a lot of assets out there. You have over 2,000 instruments. You need to know a few of them inside out. You need to know what you're doing. You need to know what you're trading. Some very exotic currencies or very exotic commodities tend to have higher cost. Okay, then cutting the losses. Very, very important to know when to let go of a losing trade. I've been doing this for 10 years, guys. I've seen thousands, yeah, tens of thousands, hundreds of thousands of accounts of trading strategies. And some people block their accounts because they don't know when to cut the losses. Sometimes, enough is enough. You got it wrong. It's fine. It's okay to take a loss of $100 today versus keeping your trade open for 3 days or 4 days, getting into a loss of $1,000, and on top of that, you still have to pay the swap. Yeah, the rollover fee. Therefore, your loss will become greater. If you only have $1,000 or $2,000 in your trading account and it goes south for a couple of days, you are risking to get into a margin call. You are risking to get wiped out. Okay, again, if that happens, it's not the end of the world. You can recover. Why? Because you know the direction. You know that you got caught, you got stuck basically in a bad trade that went against you for 2 or 3 days. The good news is usually it will recover. After it drops 2 or 3 or 4 days, it will recover. If not 100%, at least 50%. Remember the correction. There's always a correction after a big drop, yeah, or a big rise. And last but not the least, knowing the correlations, guys. It's not really a good idea to keep the eggs in one basket, to focus on one asset only when you're trading. Because what if you get it wrong? What if the market is being funny that day? What if something happens on the other side of the world that will affect your trade? This is something you cannot control. So one of the easiest ways of doing it is knowing the correlations and always have 2, 3, 4, 5 small positions open on different assets that are correlated. And you can choose 1 or 2 that have no correlation with your current positions. Again, just in case the market decides to be a bit funny and stall a bit that day. You need to balance it. There's no problem if you have 3 positions open, 2 are in a loss of $100 each, and the third one is in a profit of $100. That is how you balance your positions. Sooner or later, if you know what you're doing, or if you're a bit lucky, your positions will go into profit. It's entirely up to you how you manage those positions, how much you expose from your trading account, and you will see the exposure in the next few slides. Yeah, how it works in real life and what most of the traders do. Okay, it's not really complicated. You just need to try and understand, absorb the market. This is it. Let's move on and talk about day trading, guys. What is day trading? Day trading is a strategy used by many traders, and as the name suggests, the trading activity is taking place only during the day without leaving trades open overnight, except in rare occasions. Using this strategy, traders avoid paying the rollover fees, yeah, the swaps, and they basically rely on the movement that occurs during the day. The time frames used for this strategy are usually 5 minutes, 15 minutes, 30 minutes, even 1 hour. Even 1 hour. You can even go up to 1 hour because the day has 24 hours. If you're on a 1 hour time frame, you're looking at roughly 24 candlesticks, okay, which is plenty of time for the market to change direction. How does it work and why day traders use such a small time frame? Yeah, 5 minutes, 15 minutes, 30 minutes, and 1 hour. Basically, they're trying to draw the support resistance levels. They're trying to understand the highs and the lows of the market in that day or in the last few days. Yeah, and look at the picture in the right-hand side. It's pretty obvious. Yeah, it's quite clear that where you see the sell positions up there, that's the top, that's the roof, that's the high point. Yeah, and again, it's pretty clear that where you see the buy positions at the bottom, that is the bottom. The market might decide to stall, yeah, in some occasions, like you see towards the right-hand side. It didn't reach all the way down to the bottom, but you know the highs and the lows. So somewhere between these highs and lows is your profitable trade. Okay, if you're really, really flexible, and you have a flexible trading account and a solid trading account, you can take advantage of this entire movement. If you don't have a lot of money, or you're afraid for some reason, you're a beginner trader and you're a bit afraid, which is fine, you can wait for a signal. Basically, you wait for a confirmation that the market will go the way you predicted, and you enter somewhere there with a buy position. Again, you don't have to keep that buy position open until the price goes all the way up. Yeah, you can enter, keep it open for half an hour, 1 hour, and then exit. Yeah, you could exit somewhere there. So you will still get 25%, 30% of the movement. This is how beginner traders usually start, because they're very scared of the market. The truth of the matter is, if you allow the market to move freely, you're increasing the chances of being successful. Yeah, like we see here, for example, the market got stuck for a few hours. It didn't really move. It went up, it went down. It went up, it went down, more or less at the same pivot points. But look what happens if you don't get scared and you have enough flexibility in your account. You can close your trade up there. So after a few funny hours, let's say, where the market didn't really know where to go, it finally went to the resistance level, which is up there, creating a pattern. So after that, selling it is a no-brainer. As soon as you see the market dropping, you can go in for a sell position, setting a take profit either halfway, which is somewhere there, or all the way down there to maximize the opportunity. You can trade it in steps. The first step halfway. If it continues, you close the first position and then you open a secondary position, riding it towards the bottom. This is it. Very, very, very simple. I will take the questions, guys. I see you're typing questions. I will take the questions, but give me a few minutes. Let's get through the presentation. So day trading, yeah, you're trading during the day. Why? To avoid rollovers, to avoid paying a lot of fees. Usually beginner traders do that, or traders that don't have very big trading accounts. Traders with solid accounts, they're not really bothered. They understand they're in the game for the long run, and they understand trading has a cost. Yeah, so it's like paying VAT on your business. You know that no matter how much profit you're going to be making, your VAT is 20% or 25%. You will still have to pay 25%. But hey, you made $100,000. Yeah, I don't think anyone will be really upset if they made a good profit and they have to pay out 25%. Same happens when you have your account managed by a fund manager, by an account manager. If they manage your account, you will probably have to pay them a fee from the profits. So this is how it works. Let's move on and talk about scalping, guys. Scalping strategy is used very often by traders that are looking for short-term, fast return investments, usually news traders. Scalping means opening a big volume and closing the trade in a very short time. Yeah, we're talking about 2 minutes up to 5 minutes. That it is considered, it's still considered to be scalping. In the books, in the Forex books, scalping is considered up to 2 minutes. But if you enter and exit and you do that multiple times and you keep your position open for, let's say, maximum 5 minutes, that is still scalping. You're scalping the market. You're riding the waves up and down. This trading method involves high risk, but the returns could be great and all in a very, very short time. Usually scalping is applied on events. When you're trading the non-farm payroll, unemployment, elections, something like that, people tend to scalp. Also, the banks scalp. Yeah, know your pip value. Imagine if you're trading one lot, your pip value is $10 per lot. Now imagine if you're trading 2,000 lots. Yeah, what your pip value would be. So banks and heavy investors, they don't have to keep positions open for a very long time. They just enter and exit. Yeah, imagine placing a trade of $20 million. All you need is a movement of 3 pips and you can close the trade with a massive profit. Yeah, a profit of $20 million position could translate to, let's say, $1 million in profit in what? A few seconds, 1 minute, 2 minutes. This is the thing. So although scalping is quite dangerous and quite risky, sometimes it's worth doing it. Now, when you're scalping the market, you're riding every wave, every movement of the market, like you see in the example in the right-hand side. If you're lucky to catch such a big movement in a very short time, you're sorted. You don't have to trade again that day. If you want to make more money and you think you got it and you know what's going to happen, you can ride it again towards the downside. And you see why I'm always saying you can ride it halfway, 50%. Look at this example. Yeah, this is the correction. This is the pullback that the market did. It only pulled back 50% of the movement. So does it make sense for you to open a sell position up there when the pullback starts and set a take profit halfway? Of course it does. If you want to be more flexible, then you can keep it open for a longer period of time. And after this tiny pullback, you see it went up a bit and then it performed another pullback. This is where a lot of traders get stuck. This is the tricky part. Am I going to set my take profit all the way down there, or am I going to ride it only halfway? Very conservative traders only ride it halfway. Yeah, because it's more likely for a pullback to be 50% than almost 100% like you see here. In this case, overall, we're looking at an uptrend because the market, it keeps creating higher lows. You see the pullback didn't go to the same level with the first leg that you see here in the left. Yeah, it stopped somewhere there, which is creating a higher low. That is the indication of a potential uptrend. Yeah, then let's look further up and see what happened. Again, we see a pullback to the 50% mark, yeah, comparing to this, to the second leg, and then followed by another push. This is a clear uptrend. Once you get the indication, it becomes easy. All you have to do is make sure you don't blow up your account. You don't gamble your account by exposing 50% or 40%. And I'll show you in the next few slides what most traders do. But before we get there, let's talk about trading strategies, guys. So 2 trading strategies that everyone should know. First one is trading the news. The second one is trading the charts. Trading the news. When trading the news, the goal is short-term, fast return. Timeframes used for short-term trading are usually 5 minutes, 15 minutes, up to 30 minutes. The trading activity is done during the day, closing the trades before the markets close to avoid the rollover. That's one of them. When trading this strategy, diversification is a must. The asset classes traded short-term are Forex and commodities. Yeah, sometimes indices, especially if you manage to get in there at the market opening. Yeah, when usually markets open with a gap. Now, in the right-hand side, you're going to see a screenshot of the economic calendar. That is taken during the NFP, yeah, the non-farm payroll. And you can see that America has 6 announcements, 1, 2, 3, 4, 5, 6, in the same time. So you have the non-farm payrolls, which means the jobs that have been offered to the population in the previous month. Then you have private non-farm payrolls. Then you have unemployment rate, yeah, because the jobs offered to the population have a strong impact on the unemployment rate. And then you have a participation rate. Okay. On top of that, you have average hourly earnings. Average hourly earnings measure how much people are getting paid, basically, in comparison to the previous month. Yeah, if they got a raise, if people are overworked and underpaid, or things match. When they announce these 5, 6 announcements in the same time, you can imagine the volume that's traded on the market. You can imagine the shake off, yeah, and the impact. Imagine all the figures coming out positive. You will see the dollar skyrocketing. Okay, or imagine all the figures coming out negative. You will see the dollar dropping like a rock. How do you trade such events? The event has to do with the US dollar, correct? Yes. So look at the bottom of the screen. If you think the dollar will strengthen, then you can open a buy position on all the currency pairs that have the dollar as the base currency, yeah, which is the left-hand side. So USD JPY, USD CHF, USD South African Rand, USD Canadian dollar. Yeah, these are a few of the USD pairs that have the dollar as the base in the left. In the same time, what do we know? If the dollar goes up, the other currency drops, yeah? So looking at Euro US dollar, if you bought the US dollar and the US dollar is the base, what will you do with the euro? You will sell the euro. You will sell the pound. You will sell the Australian dollar, yeah, and the Kiwi dollar as well. Even more than that, gold and silver have a negative correlation to the US dollar. They move in opposite directions. So you could open a sell on gold and silver as well. And this is how you end up diversifying your positions and creating a portfolio. Why is that important? The US dollar has a different relationship with the other peers. Yeah, so if USD JPY is going to move 10 points, USD CHF might move 40 points, 50 points, 80 points. You don't know how much the movement will be. USD South African Rand might move only 5 points, yeah, or 50 points, and so on. So the movement won't be the same on all your trades. I got caught at the very, very beginning when I started trading first time. I was afraid to open multiple positions and diversify like this. And when I was trading events, I was opening one position, let's say two, with a push. One of them was making me $5, the other one was making me $100. But till I realized that, I lost a lot of money by not opening another position. Yeah, because if you're unlucky and you just focus on the USD JPY and that refuses to move during that announcement, it will not move a lot. You didn't make any money, you didn't lose any money, you just watched a big shake off and missed the opportunity of making profits, if it makes sense. So very, very important to see the bigger picture. You don't have to go 10 lots USD JPY. No, you can go 0.1, 0.5, 0.8 lots. One lot on USD JPY, half a lot on USD CHF, half a lot on USD South African Rand, and so on. Yeah, so you don't have to blow up your account by opening infinite buy or sell positions. Yeah, remember, the 10% is where most traders are when they're trading, when they're exposing. That's come like 10% what they use from their balance to trade. Now, trading the charts, technical analysis. This is where technical analysis comes in handy. When trading the charts, the goal is mid to long-term growth. One thing I need you to understand, guys, is that CFD trading is not really designed for super long-term positions. Yeah, CFD trading is designed to trade fairly short-term. Yeah, either few hours to a few days to maybe a couple of weeks. Okay, because you have various costs here like spread swap and all that, and it will add up at some point. If you manage to open a position where you have a positive swap, where you're receiving money by keeping that position open every night, and your position also goes into profit, then you might as well keep it for the long run, because you're making money two ways. One, for keeping your position open overnight, and two, your position is already in profit. So you can keep it open until the market decides to turn around. Now, timeframes used for trading the charts are 30 minutes, 1 hour, 4 hours, and 1 day. Yeah, because you need to allow the market to swing between its support resistance levels. The trading activity also happens over at least 48 to 96 hours, allowing the market to move freely without using a stop loss. The take profit and stop loss are optional, guys. You can use a stop loss or you can decide not to use a stop loss. Depends on how solid your trading account is and how much you are exposing from your trading account. Yeah, if you're exposing 50%, then you might want to use a stop loss because you're going to get wiped out if the trade goes against you. But if you have, for example, $100,000 in your trading account and what you're using to trade is $1,000, then you can trade without a stop loss if you want, because the probability of you getting wiped out of such a big shake off of the market overnight is very unlikely to happen. Okay, that's the difference between these two trading strategies. Diversification and take profit again are recommended even for long-term trading for better results. This strategy includes all asset classes as long as the account has the flexibility. Again, how does it work? Very similar to the previous setup. Yeah, when you're trading the news. If you think the dollar will weaken, again, you can short, you can sell all the currency pairs that have the dollar as the base in the left, and you can buy all the currency pairs that have the dollar in the right. Also, you know gold and silver move in the opposite direction, and you also know that Dow Jones and the S&P 500 tend to move in the opposite direction from the dollar. So again, it's a no-brainer. You can diversify your positions. Maybe some of them will move way faster than others, and they will take you into profit. In the right-hand side of the screen, you see a trend channel, which again highlights the tops and the bottoms, the average highs and the average lows. And again, if you want to play it very safe, very conservative, once you see the trend channel and you open a buy or sell position, ride it halfway. Yeah, you don't have to place a take profit. For example, if you sell here, you don't have to place a take profit down there. You can place a take profit halfway just in case the market, is being a bit funny. Eventually, the market will complete the pattern, and you can see it next day or in a couple of days, depending when this screenshot, what was the time frame of the screenshot. The price went down to test the lows, the average lows. And then what happened? Again, it went back up. Yeah, where it's trying to go back up. So you buy when it's down here, you sell when it's down there, and you keep an eye on the center line, halfway. And if it goes your way, you can close your position and reopen another position. It's entirely up to you. Or you can open a position, wait for it to go halfway. Once you get the confirmation that the market wants to continue the pattern and go all the way down there, you can open a second position, to double up on the profit, because you got the indication that the market wants to continue, wants to complete the pattern. Not difficult, is it? If you look at it this way. All right, let's move on. Let's have another look. Yes, this is the support and resistance level. This is how you draw your support resistance level. Basically, most of the highs and most of the lows must touch the line. Occasionally, you will have tops or bottoms going outside this line, but that very likely was triggered by a bit of excess volume on the market or by an announcement that created a shake off for a few hours. Shortly after that, the price will fall back into its channel, regardless of being an uptrend or a downtrend or a ranging market. Now, let's make it a bit more complicated, guys, and talk about trading strategies. So, you have a few ways to trade. First of all, choose the direction. Yeah. After the drop, or even if the market is on a downtrend, you can go for the correction, which usually is 50% from the movement. So your indication will be here for a buy position. Your first target, the T's represent target, where you could potentially set your take profits, where the asset is very likely to go. You start with the closest target, which is target 0, which is the halfway, the 50% that I was telling you about. So a buy position is taken when the trader considers the market in a trend and expects the movement to last for at least a few hours. Please note that the time frame used on this example is 4 hours per candlestick. Therefore, the movement is expected to happen over at least 2 trading days. Okay? You have to allow the market to breathe. The bigger the time frame, the higher the time frame, the more accurate your technical analysis will be. Okay, it's all the same pattern. Anything can shake off the market within 1 or 2 or 3 hours, but it's unlikely for something to happen that's going to shake off the market for a week or 2 or 3. Yeah, that has to be severe. That has to be very big. So it makes a lot of sense to trade the market gradually. Yeah, you don't know what's going to happen from T0. From T0, you might see another pullback. The downtrend might continue. And that's the perfect time to ride it with a sell position. Talking about a sell position, there you go. That's your sell position. A sell position is taken when the trader considers the market is in a trend and expects the movement to last for at least a few hours. Again, note that the time frame used on this example as well is 4 hours, yeah, per candlestick. So again, you're expecting a movement to happen over 1, 2, or 3 days. Why is that? Look at the top. The market was stuck there. Yeah, and that is a 4-hour chart, so 4 hours per candlestick. How many candlesticks are there? Yeah, I'd say anywhere between 15, 20 candlesticks. Times 4 hours, it's a few days. For a few days, the market refused to move. So no matter how stubborn you are as a trader, you will struggle to make profit there. Yeah, so it makes a lot of sense taking a step back and looking at a higher time frame. Now, I want to mention something which is very, very important. You can't really trade on a very high time frame like this with only 250 or 500 or $1,000 in your account. It's very, very dangerous because this tiny shake off that you see on the chart can blow your account up. So if you choose to trade like a pro, if you choose to allow the market to breathe and calculate your entries and your exits, make sure you have enough flexibility in your trading account. If you have $10,000, you can use $1,000 to trade with, knowing that you have $9,000 spare, so you don't get wiped out. It's very unlikely to get wiped out if you only use $1,000 from your account and you have $10,000 in your balance. It's very, very unlikely. That means the market should crash. And a market crash usually happens every 8 years to 10 years. So this is, I think you understand my point. Yeah. See beyond what other people show you. Yes, see beyond profit 5 minutes today, tomorrow, and that's it. Once you manage to take a step back and expand your horizon, things will start picking up. They will start making sense for you. Again, on a sell position, guys, that is a confirmation that the market wants to drop. So you saw the high, then you waited for a few, 1 or 2 days. You saw the market was a bit funny, and then you can expect the confirmation for a sell position. Again, you ride it halfway to T0. If all goes well and you're looking at a reversal, at a change of trend, then you can go for T1, even T2. But very careful, and remember, it's going to take a few days for the price to go from where you entered with a sell to the T0, yeah, because it's a 4-hour chart. Okay, let's move on. A third strategy is hedging. I don't know how many of you are familiar with hedging. Type, by the way, let me know if you're familiar with hedging. Type a yes or a no. Have you heard of hedging before? Do you know what it is? Have you ever used it? Let me know. Now, hedging means opening a buy and a sell in the same time. Usually a hedge strategy applies on a ranging market when you don't know exactly what's going to happen. So in this example, again, Euro US dollar on a 4-hour chart, 240 minutes per candlestick. And you see the market is very, very choppy. It's hard to predict the highs and the lows. You're not very patient. Yeah, let's say the price action is here. Yeah, you're not very, very patient. You don't know, is it going to go up? Is it going to go down? Because judging, if you draw a trend line, it looks like a downtrend if the price action is here. Yeah, but also it might be a ranging market. You can see average highs, average lows. Yeah, this is the excess I was telling you about when on rare occasion the market has a shake off. Again, you can see it at the top. What happened after 1 or 2 or 3 days? Things came back to normal and the market went into its range. So If you see a similar setup to this and the price is halfway, you don't know what to do, many traders decide to open a buy and a sell in the same time, setting the take profit and the stop loss for both positions. And from there on, all you have to do is wait. What will happen? You will have a swing of the market. So one of the positions will go into profit. When the market goes to its average highs or its average lows, your position will close with profit because you placed the take profit, and it's time to ride it the other way around. Yeah, where again, you have a take profit. Now, very careful, the stop loss for these positions is usually placed here. Yeah, so your buy becomes a stop loss for the sell and your sell becomes a stop loss for the buy. It's the hedging strategy is a bit more complex. It works most of the times, but again, depends very much what your target is, what you are targeting as a trader. Okay, we will get to that. If you want more training on the hedging strategy, I am available for one-on-one sessions. All you have to do is contact support or your account manager, let them know you want the one-on-one session with me, and they will put it in my calendar. We will make it happen. Okay, so this is how it works. You either buy, you either sell, or you hedge. Let's move on and talk about take profit and stop loss for the very beginner traders. Take profit is a target price for closing a position in profit, so you don't close it manually, so you don't stare at your computer screen for hours and hours and days. Don't do that, guys. I fell into that trap when I started trading. I know a lot of beginner traders do. Staring at your screen does nothing else than taking your blood pressure very, very high. Yeah, if you're a smoker, you probably go to smoke a pack of cigarettes in half an hour, because every single movement of the market will make you very, very nervous. So the easiest way to do it is set your take profit, stop loss, and walk away. Allow the market to breathe. One of the two will happen when you come back. Either your position will be closed with profit, either your position will be closed with a small loss. Now, the stop loss stands for target price stop loss and target price for closing a position with a loss. Now, take profit and stop loss, as you see, are optional. It's a good idea to use them sometimes. And the ratios are very, very important. Most traders tend to use a ratio of 3-to-1 between the stop loss and the take profit. The bigger the ratio, the higher the ratio, the better you're going to do. But a realistic ratio is either 2-to-1 or 3-to-1. What does that mean? If you lose $100. If you're going to make profit, you will make $300 profit. That's the 3-to-1 ratio. That works very, very well. If you have 10 positions open and 6 positions are losing you money and 4 positions are making you money, if you apply this 3-to-1 ratio, overall you will be in profit with only 4 positions in profit and 6 losing positions. I can prove it in a Word document anytime. Let's move on. So the patterns of the market. Here we're looking at what is this? It's a daily chart. So every candlestick represents one day. Yeah, you can see you're looking at the charts from September 2016, yeah, till June 2017. What do you see? You see a downtrend, you see the market's calming down, and then you see an uptrend. There will always be a correction, guys. So you can trade the highlighted squares that you see here. Usually retail traders with small trading accounts can't afford to trade such a long term, and they just enter and exit during the day somewhere there. Yeah, or over a few days. But what I want to show you is that the same pattern repeats on a small time frame, on a big time frame, on a medium time frame. This is what the price does. Goes up, goes sideways for a bit, then comes back down, or goes down, goes sideways for a bit, and then it comes back up. As easy as that. Correlations, guys, very, very important to know your correlations when you're trading. What positions will you open? I think from the Forex side of things, you understand now what the base currency means and how to treat the dollar as the base, how to trade the dollar when the dollar is the base, sorry. What other assets can you trade? What else is correlated to the dollar? Now, let's see the ones that have a negative correlation to the dollar, meaning the ones that tend to move in the opposite direction. Gold, silver, S&P 500 and Dow Jones, yeah, the big two big American indices. Obviously, the euro, the Aussie dollar, and the Canadian dollar. Okay, it's logic. When the dollar goes up, the euro comes down, the Aussie dollar comes down, the Canadian dollar comes down in that currency pair, yeah, Euro USD, AUD USD, and USD Canadian. In the right-hand side, you see more correlations. You see some pairs that tend to move together. Yeah, Euro USD and GBP USD. Why do they tend to move together? It's very, very simple to understand. You have America trading against Europe. Yeah, the euro and the pound are two European currencies versus the US dollar. So when the dollar goes up, the European currencies tend to drop in respect to the dollar. This is it, as easy as that. Then again, Kiwi dollar, yeah, Euro USD and the Kiwi dollar, the New Zealand dollar, again, tends to move in the opposite directions. So does the Australian dollar. Yeah, so if you're trading AUD USD, you might as well trade NZD USD as well, because they move in the same direction. They move together. Okay. Right. You have a few currency pairs that don't move together. Yeah, Euro USD and USD CHF, GBP USD and USD JPY. Because America has a certain relationship, yeah, with these countries, and they tend to move again in opposite directions. Not very complicated. All you have to do is treat the dollar as the strong or the weak asset. Right. And here is the exposure I was telling you about, guys. What traders do. On accounts below $1,000, the exposure used is many times 25 to 30%, exposing the trader to very high risk as the trader can't sustain a potential losing trade until it recovers. Or the trader wants to open a few trades, a few correlated trades, and the trader ends up exposing 25, 30% from his account. If the market decides to stall for a bit that day, the risk increases. Yeah, the risk of you getting into a margin call or getting wiped out increases dramatically. Now, on accounts between $1,000 and $10,000, the exposure used is approximately 10% or below, yeah, lowering the risk factor, but still being quite dangerous in case of a strong market shakeoff that might last for days or weeks. Yeah, no one could have predicted the situation in the States. Okay, I don't want to go there. I don't want to talk about it, but you all know what's happening in the States, and I'm not referring at the COVID-19 situation. I'm referring at the protests that took over Europe and many other countries around the world. Now, a shakeoff like that might last for weeks and days. Yeah, because people prefer to go out on the streets and set shops on fire, and shops are not functioning properly, people are not going to work because they're protesting and so on. So that situation will last for weeks, very, very likely. The dollar, in this case, will go down for a few weeks. That's why even if you expose 10% and you want to trade long term, it might become dangerous. Will you get wiped out? Unlikely. Yeah, even on a $10,000 account, if you're using 10% and something happens that adds a drawdown to your account for a couple of weeks, probably you will not get wiped out. Yeah, you will have a drawdown of 50%, 60% on your account. You might get into a margin call, but very likely you will not get wiped out. Okay, it's all about not fighting the market. Yeah, it's like swimming when you catch a current. Yeah, do not fight the current. Go with the current for a bit of time, and then you will get out of it. Now, on accounts over $10,000, the exposure used is 5% or below, offering the trader enough time, money, and flexibility to take action in case of any potential losing trade. This is it. The less you expose from your trading account and the more you have in your trading account, in theory at least, the better you will do. Yeah, please note that the less you expose from your balance when trading, the lower the risk of losing your investment becomes. Yeah, for that reason, you might have that drawdown. You might have a factor that's going to send you to a bit of a loss for a few days. Now, at that point, you have two options. Either you cut the losses and you ride the wave, yeah, the sell position, if you're stuck in a buy position, or you keep your positions open and hope the market will recover. You have to be very aware of what triggered that event, yeah, how serious that event is. Now, your favorite time of day, guys, Q&A time, Q&A time. Let's take a few questions. All right, the first question I'm going to take is from Alvaro. Let's see. When do you know where to buy and where to sell? Seeing the moving average. When they cross, Alvaro, you're not only, when you're trading moving averages, you need minimum 2 or 3 moving averages. And when they cross, that's your signal. Okay, if you trade the 10, let's say the 10 and the 20 moving average, you know that the 10 moving average will be the closest one to the candlesticks, and the 20 moving average will be a bit further. Yeah, when the market is in a trend, they will be separated. When the market reverses the trend, yeah, the one that's closer to the candlesticks will cross the other one, changing direction, and that's your signal. Yeah, your buying or selling signal. It makes sense? All right. Now let's take another question. Okay, Alex is asking me, what do you think about the US dollar? What do I think? It's a great currency. I don't know. It's the reserve currency of the world. Leaving the joke aside, I think you're referring to when will the dollar start strengthening again? Now, we all know what's happening with America. You're very welcome, Alvaro. If you want heavy training on moving averages, let me know. We can make it happen. Yeah. All right. Now, talking about the US dollar, we all know the situation in the States right now. We all know that people are getting ready for elections. They started, and it's the worst timing possible. Yeah, the COVID and the protests and elections and everything. So what do I think? I think it will stabilize eventually. I think America is going through a very hard time right now, as it is. And it will stabilize. When will that happen? I can't give you an answer. When something good will happen on the market. Okay, soon, fairly soon, because the more it continues like this, the more it will destroy the economy. So we all know, as much as some people don't like Donald Trump as a president, as a business person, he's really good at what he does. He did manage to make America great again. He wanted to show the world that you can't mess about with the United States of America. They're a huge power you don't mess about with. And he made a statement, yeah, with the tariffs, with threatening with tariffs in Europe. He basically threatened everyone, but the point was to try and get money back into the country, money back into the economy. He even tried to bring some companies back home. Yeah, but then they kind of explained to him that it costs 10 times more to produce something in the States versus producing something in China. And from the money point of view, I think he got it. But if I remember correctly, at some point about a year ago, he went public and said he's willing to ease off some taxes for tech companies. I think Apple was one of them. Yeah, the big boys said, if you bring them back to the States, we will ease off the tax for you. So from the business point of view, he's doing great. If he will be allowed to take over again, I think he will manage to make America great again. Yeah, because he done that last year. Now we see a pullback, which is quite severe, but I think he will definitely manage to do something really good for America from the money, yeah, from the finance point of view. I don't want to get into his speech, yeah, his way of acting, his way of speaking. I don't want to get into politics, but as a business person, he did a great job. So what will happen with the dollar is that it will stabilize, and then slowly, but surely will go back to its comfort zone. Right, let's take another question. Right, okay, Haji is asking, why is it that most of the US companies tend to move on the same direction? What do you mean? I mean, the tech companies, you mean? Right. When it is simple to understand, I don't know, it's so simple to understand, I'm having difficulties explaining it to you. When the stock market, the stock market in the States is not only kept alive by locals, by Americans. The stock market in the States, or the stock market in any country, is kept alive by foreign investors as well as locals. So whenever the country goes through a hard time, investors take a step back because they're afraid the market will crash. You have two types of investors: the ones that sell and take advantage of the market, and the ones that take a step back and they say, I don't want to get involved in the in trading American stocks because America is going through a rough time. What if I lose my money? Okay, that's why they tend to move in the same direction. They move together because traders take a step back. They missing the trust. What drives the stock markets around the world, guys, is trust. People's trust in the stock market. That is it. Stocks are driven mostly by the news. So whenever something happens, people tend to take a step back. Okay, right. Let's take another question. All right. Why, when I open a position, the market moves the opposite way? Okay. Good question. If it happens every single time, it means you're calculating your entry wrong. Okay, you shouldn't really care, especially if you're a beginner trader, what happens with the position immediately after you open the position. Give the market the time to breathe. Give the market half an hour, 1 hour, 2 hours, 4 hours if you have to. That's one. The second one, why when you open a position, your position might go in a bit of a loss, is because of the spread. You chose an asset that has a floating spread. And at that point, the spread might be a bit higher, because at high peak trading, the spread increases a bit. Again, not from Forex Cube side, but from the exchanges. Okay. Come on, let's take one more question, guys. Wow, I've been talking again for an hour. I do speak a lot, guys. I'm sorry, but I think you understand why. I'm trying to help as much as possible. Okay, what do I think is going to happen with the DAX from Friday to Monday? It's going to be shut down. It's going to be closed. I can tell you that for a fact. What's going to happen on Monday at the opening, that I cannot say. If we analyze the charts, I can tell you what's going on from the technical point of view. But again, events that happen over the weekend will have an impact at the market opening on Monday. All right. Now, this was it, guys. Remember the two special offers Forex Cube has this month. Refer a friend and get $50 into your trading account. Start trading today with up to 10 easy installments. On forexcube.com, you will have all the details. You can download the terms and conditions if you're interested in trading with installments. Remember, guys, on Tuesday, very big day, very important. We have a special edition with Joao Monteiro in the studio. I'm very excited. I'm very excited. We're going to have a webcam as well. We're going to have image as well. So it's going to be very interesting. Don't forget to register. You can register on forexcube.com/webinars. Register for the special with Joao Monteiro on Tuesday, 30th of June. It's going to be amazing. This being said, guys, I thank you again for being with us today. Join me on Tuesday for the last and the biggest webinar of this series. Until then, remember to trade responsibly and may all your trades be in the money. The Chart Whisperer, over and out.